Chapter 2, Review of Accounting. Chapter 2 Outline, Accounting and Finance, Income Statement, Income and Value, Balance Sheet with IFRS Impact, Income and Cash Flow, Statement of Cash Flows, Free Cash Flow, Tax and Financial Decision, Summary and Conclusions. Learning Objectives. Prepare and analyze the 4 basic financial statements. Examine the limitations of the income statement as a measure of a firm's profitability. Examine the limitations of the balance sheet as a measure of a firm's financial position. Explain the importance of cash flows as identified in the Statement of Cash Flows. Learning Objectives Part 2. Identify the effects of IFRS, International Financial Reporting Standards, on financial analysis. Outline the effect of corporate tax considerations on after-tax cash flow. Identify the different forms of investment income and the effects on investors' taxes payable. Explain the concept of tax savings for companies. Accounting and Finance. Finance is about making decisions to produce value. It is important to understand a firm's past and present financial position. Accounting provides such information, organized into 4 financial statements. 1. Income statement. 2. Statement of retained earnings. 3. Balance sheet. 4. Statement of cash flows. Income statement. An income statement measures profitability for a time period, for example, 1 year. Revenues minus expenses equals net income. Revenues from customers for services or merchandise. Expenses from vendors for merchandise, services, or supplies. Table 2-1, Income Statement. Kramer Corporation Income Statement for the year ended December 31st. So you have sales minus your cost of goods sold to equal gross profit, minus selling and administrative expenses, minus depreciation expense to give you operating profit, which is known as earnings before interest and taxes, minus interest expense to get earnings before tax, minus taxes to get earnings after tax. Then you have your preferred stock dividends, subtract that, and you'll end up with your earnings available to common stockholders. Your common shares outstanding is the number of shares that you have outstanding and issued. And when you divide your earnings available to common stockholders by your common shares outstanding, you get earnings per share. Return on capital. We should note that the return on capital to the 3 primary sources provided by investors: creditors, bonds, $20,000 in interest; preferred shareholders, $10,500 in dividends; common shareholders, $100,000 of earnings available. Table 2-2, Statement of Retained Earnings. The Statement of Retained Earnings is the link between the income statement, profit and loss, and the balance sheet. So you have your retained earnings at the beginning of the period. You add earnings available to common stockholders, and sometimes if there's no earnings, you'd have a loss, so you would subtract that. Then you deduct the cash dividends declared during the year, and you will end up with your retained earnings end of the period. Valuation basics from the income statement. Shareholders' claim on earnings is a fundamental measure of value. Earnings per share equals earnings available to common shareholders divided by the number of common shares outstanding. So in the example that we're using, you have 100,000 divided by 100,000 shares equals $1. Valuation basics from the income statement Part 2. The payout ratio measures the percentage of earnings paid out immediately in dividends. Payout ratio equals dividends per share divided by earnings per share. So in this example, you have 50 cents divided by $1 equals 50%. Valuation basics from the income statement, Part 3. Shareholders' reliance on earnings will influence the price they are prepared to pay for shares of the firm. The PE ratio, or price to earnings ratio, equals the market share price divided by the earnings per share. So you would do $12 divided by $1, which would equal 12. Table 2-3, price earnings ratios for selected companies. So you have the list of corporations, the industry that they're in, and the PE ratio from 1992 all the way to 2019. Valuation basics from the income statement, Part 4. Measures the percentage of earnings paid out immediately in dividends. Dividend yield equals dividends per share divided by market share price. So if the dividends per share are 50 cents and the market share price is $12, you would have a dividend yield of 4.17%. Limitations of the income statement. Income statement records past events, which are irrelevant for valuation purposes. Accountants focus on income while financial managers and analysts are interested in value. Accountants have some flexibility in reporting transactions and resultant income. Balance sheet. The balance sheet, statement of financial position, is a snapshot picture that indicates the firm's holdings, what the firm owns, obligations, financing as liabilities or equity, ownership interest, measure of its value at a point in time, cost basis compared to various IFRS valuation methods. Classifications on the balance sheet. Assets, what a business owns. Current assets, for example, accounts receivable, inventory, will be sold or used up within 1 year. Capital assets, for example, building equipment. Classifications on the balance sheet, Part 2. Liabilities, what a business owes. Current liabilities, for example, accounts payable, they're due within 1 year. Long-term liabilities, due sometime after 1 year. Classifications on the balance sheet, Part 3. Equity, what the owners have invested in the business. Shareholders' equity, capital stock, retained earnings. Effects of IFRS on financial analysis. Most countries, including Canada, have accepted the International Financial Reporting Standards, IFRS. Public companies now report their annual financial statements applying IFRS, along with comparative previous year's figures. It makes the financial statements completed under the IFRS comparable to other companies worldwide, using similar IFRS standards. Effects of IFRS on financial analysis, Part 2. Most financial topics will be affected by IFRS applications, especially financial statements values, ratio analysis, determination of cost of capital, and capital budgeting decisions. The balance sheet, assets. Asset accounts are listed in order of liquidity. Marketable securities, accounts receivable less allowance for bad debt, inventory valued at cost, and prepaid expenses. The balance sheet assets, Part 2. Longer-term assets will be investments held longer than marketable securities, plant and equipment less accumulated amortization. Table 2-4A, balance sheet GAAP presentation. So in this example, we have the name of the company, the name of the sheet, so this is balance sheet, and the period, December 31st. We list our assets in order of liquidity, so current assets go first, and then long-term assets go second. And then you total up your assets for total assets. Table 2-4A, balance sheet GAAP presentation, Part 2. So we have the second part of the balance sheet, which is liabilities and shareholders' equity. And this is done in order of liquidity again. So we list our current liabilities first, then our long-term liabilities, then we total all of our liabilities, then we list our stockholders or shareholders' equity, we total our shareholders' equity, and we add the total shareholders' equity to the total liabilities to get total liabilities and stockholders or shareholders' equity, and this always has to equal your total assets. Table 2-4B, balance sheet, IFRS presentation. So under IFRS, some companies may choose to report their assets in reverse liquidity order. So the only difference is we would start with our long-term assets first, and then we would work down to our most liquid assets, which are current assets. And then we'd add everything up and have the same total assets. The same thing with the balance sheet because it's reverse liquidity order. Some companies may choose to use this presentation, and the only difference is we would start with our shareholders' equity, then move to our long-term liabilities, and then come up to our current liabilities, and then we would have the same total liabilities and shareholders' equity. The balance sheet liabilities. Current liabilities. Short-term obligations due within 1 year. Accounts payable, notes payable, accrued expenses. Longer-term liabilities are obligations due more than 1 year, like bonds payable. Valuation basics from the balance sheet. One number related to a firm's value on the balance sheet is net worth or book value, which is defined as shareholders' equity minus preferred stock. It represents common shareholders' original investment plus all earnings reinvested in the firm so far. Valuation basics from the balance sheet, part 2. Analysts often calculate the relationship between market value per share and historical book value per share. So you would have market value divided by book value, or market value per share divided by book value per share. Table 2-5, comparison of market value to book value per share December 2019. So we have our list of corporations, we have our market value per share, we have our book value per share, and then we have the ratio of market value to book value. So you just take the market value divided by book value. Limitations of the balance sheet. Values are stated on a historic or original cost basis for private companies, but public companies must report IFRS at market values. Accounting policies and methods used, for example, amortization, inventory valuation, will influence the recorded values. Contingent liabilities are omitted from the balance sheet. Income and cash flow. A profitable firm does not necessarily generate high cash flow, probably because it sells on credit. Accrual accounting attempts to match revenues and expenses even if the related cash flows occur at quite different times. Income and cash flow, part 2. Financial managers are only concerned with cash flow because only cash can be spent. The statement of cash flows reports changes in cash and cash equivalents resulting from activities of the firm during a given period. The statement of cash flows. The statement of cash flows measures the flow of cash into and out of a firm. We have operating activities, those are cash flows from operating activities, plus financing activities, these are cash flows from financing activities. Then we have investing activities, and these are cash flows from investing activities. And you add those 3 categories together, and you get your cash flow, which is your net increase or decrease in cash. Figure 2-1, illustration of concepts behind the statement of cash flow. Cash flows from operating activities. Cash flows from investing activities. Cash flows from financing activities. Add items 1, 2, and 3 together to arrive at net increase or decrease in cash. So cash inflows are made up of generation of funds in normal operations, sale of plant and equipment, liquidation of long-term investment, sale of bonds, common stock, preferred stock, and other securities. Our cash outflows are made up of expenditure of funds in normal operations, purchase of plant and equipment, long-term investment, retirement or repurchase of bonds, common stock, preferred stock, and other securities, and payment of cash dividends. Sources, uses of cash. Operations. Cash paid and received from buying and selling of goods and services. Investments. Cash paid and received from investment activities, bonds, stocks, property, equipment. Financing. Cash paid and received from financing activities, dividends, borrowing or issuing stocks, repayment or issuing debt. Figure 2-2, steps in computing cash provided by operating activities using the indirect method. Net income plus amortization and other non-cash items minus increase in current assets plus decrease in current assets plus increase in current liabilities minus decrease in current liabilities equals cash provided by used in operating activities. Table 2-6, comparative balance sheets, ASPE, GAAP. So we have the 2 years of the balance sheet, XX is your current year, and XW is your previous year. Table 2-6, comparative balance sheets, ASPE and GAAP, Part 2. It's the same thing, except for we're just showing the liabilities and shareholders' equity portion of the balance sheet. Table 2-7, cash flows from investing activities. So you take your operating activities, which is your net income of 110,500, add items not requiring an outlay of cash, so you add back your amortization of 50,000, which totals cash flow from operations, which is 160,500. Then you add and subtract the changes in non-cash working capital to get a total net change in non-cash working capital of minus 10,000. And you add that to the 160,500, and you end up with cash provided by operating activities of 150,500. Table 2-8, cash flows from investing activities. Investing activities. Increase in investments, long-term securities, minus 30,000. Increase in plant and equipment, minus 100,000. Total cash used in investing activities, minus 130,000. Table 2-9, cash flows from financing activities. Financing activities. Increase in bonds payable, 50,000. Preferred stock dividends paid, minus 10,500. Common stock dividends paid, minus 50,000, for total cash used in financing activities, minus 10,500. Table 2-10, statement of cash flows. Here is the example of the statement that you would put together. So you start with the name of the company, the name of the statement, and it's for the period ended. In this case, it's for the fiscal period, which is a full year. We start with our operating activities. Then we move to our investing activities. Then we move to our financing activities. And then we add those three together and you get your net increase or decrease in cash during the year. Then you add the cash that you have at the beginning of the year, and then that will give you the cash at the end of the year, which is also the cash that shows on your balance sheet. Table 2-11A, comparison of accounting and cash flows. So in the first column, you have year 1 accounting flows, and in the second column, you have your year 1 cash flows. And then you have for year 2, in the first column, which is column A, you have your accounting flows. And then in year 2, column B, you have your cash flows. Free cash flow. Free cash flow can be calculated as cash flow from operating activities minus capital expenditures required to maintain the productive capacity of the firm, minus dividends needed to maintain the necessary payout on common stock and to cover any preferred stock obligation. Free cash flow part 2. FCF represents cash available for special financial activities, leveraged buyouts, share buyback, mergers and acquisitions. Free cash flow is reviewed to determine if there are sufficient excess funds to pay back the loan associated with leveraged buyouts. Income tax considerations. Income taxes affect financial decisions. Corporate taxes vary by province, by type of business, and by size of business. Cash flows after tax are most relevant for decision making. After-tax investment income paid to shareholders or other individuals varies depending upon the form of the income. Expenses deductible from taxable income provide a tax shield, tax savings. Cost of a tax-deductible expense. Example of 2 corporations. Corporation A pays $100,000 in interest payments. Corporation B has no interest payments. So our earnings before taxes for Corporation A is $300,000 and Corporation B is $400,000. The tax on Corporation A is 30% and same with Corporation B. So you get taxes of $90,000, which is $300,000 times 0.3, and $120,000, which is $400,000 times 0.3. And the difference in their earnings after tax is $70,000. So Corporation A has earnings after tax of $210, and Corporation B has earnings after tax of $280. So the difference between those two earning after taxes is $70,000. Amortization capital cost allowance as a tax shield. Example of 2 corporations. Corporation A deducts $100,000 in amortization. Corporation B does not claim any CCA. So we have our earnings after taxes of $210 and $280 for Corporation A and B respectively. We add the amortization deducted without cash outlay, which is $100,000 for Corporation A and $0 for Corporation B. And the total for Corporation A is $310,000. The total for Corporation B is $280,000 for a difference of $30,000. Summary and conclusions. Financial statements provide financial managers with information about the firm's profit, assets, liabilities, equity, and cash flow. Financial managers should be aware of the limitations of financial statements. International financial reporting standards' most significant impact is on the format of the balance sheet, the valuation of assets, and ratio analysis. Summary and conclusions part 2. Financial managers should focus on cash flow as only cash can be spent. The statement of cash flows gives a rough picture of operating cash flows and the nature of the firm's investment and financing activities. Tax affects individual and corporate decision making.